Hi everyone, today we're going to be solving the COMM 217 2011 midterm, question 1, so the multiple choice section. So let's begin. So number 1, XYZ company showed total assets of $150,000 and total liabilities of $60,000 as at December 31st, 2010. During 2011, if total assets increased by $60,500 and total liabilities decreased by $42,000, then shareholders' equity is what? So, for this question, they want you to know what the general accounting equation is, which is assets equals liabilities plus shareholders' equity. And in the question in 2010, it said that assets was $150,000 and liabilities was $60,000. So, when you solve algebraically and you bring the $60,000 over, which is going to turn into a negative, you get shareholders' equity for 2010 to be $90,000. But in 2011, they said that assets increased by $60,500. So now the assets is 2010 500, and then they said the liabilities decreased by $42,000. So that makes the liabilities now $18,000, and they still didn't give you shareholders' equity, so you just do the same thing and go 2210 500 minus the 18,000, which is going to get you a shareholders' equity of 192,500. But now they're asking you what the increase was. So you just take the 2 years and get the difference, which is 102,500 as your answer. And as you can see, C shows that answer, and that's what we get. And let me just go and erase this now so we can do the next question. So for 2, current assets are listed on a statement of financial position by order of liquidity, by size, with smaller amounts shown before larger amounts, by alphabetical order, or D, in any order the accountant chooses. Well, first question is not that intuitive. It's pretty much a straightforward definition, and in the accounting policy, it says that for current assets, the assets should be listed in order of equity. So just as an example, it should be cash because cash is the most liquid. So you can't convert because cash is converted into cash, and then it will go into accounts receivable and then inventory. So this is an example of an order of liquidity. So as you can see, A shows the exact definition, and that would be your answer. So for 3. The usefulness of the debt-to-equity ratio is that it allows interest party to assess what? So before we answer this question, the debt-to-equity ratio is the liabilities over shareholders' equity. And this pretty much shows you how much debt you have that you financed for assets compared to how much money your company earned or how much money your investors put into the company. So the exact definition in your textbook is that the ratio assesses how much you finance your assets. So A says how the company finances its assets. So that's true because that's what the ratio definition is. B, the relative risk assumed by the company because of debt financing. Well, that's true because if your liability is high, so let's say if your shareholders' equity was 10 and your liabilities were 9, this could show you that you're financing way too much and you're not having that much equity that you'll be able to decrease your debt by. So that's true. We said A was true. And then C is whether the company should expand its use of debt to financing assets. So like we said that a too high of a ratio is bad, but let's say if you had $2 of financing your assets and you still had 10 of shareholders' equity, this is also bad because if you have a good amount of equity to finance, you should, because that would help grow the company. And if you're not financing your assets, then you're not really using any good use of your extra equity. So that is true also. So the answer for 3 would be D. Number 4. Which account is least likely to appear in an adjusting journal entry? So whenever you're doing an adjustable journal entry at the end of the year, the major component of adjusting journal entry is that you should know that when you see adjusting journal entry, you should always think that there's no cash. Because adjusting entry is just adjusting the accumulation of interest or rent, and you didn't actually pay off anything off. So property tax expense is adjusted at the end of the year because you're going to calculate your property tax, so that would not be the answer. Interest expense, well, interest expense is accumulating throughout the whole year, so at the end of the year, you would have to adjust to see how much interest expense receivable you've earned, so that would not be it. And salaries payable, for example, let's say the 2 weeks before the year of the end, you have to calculate how much your workers actually earned, so you have to adjust that. And like we said, in adjusting entry, there's no cash available or used, so the answer would be A, cash. So number 5, which of the following statements regarding depreciation of a building is incorrect? So A, depreciation represents the decline in the value of the building. That's questionable, and we'll get back to it because the term value is something that raises concern, but let's go to the other answers and see if they're incorrect. B states depreciation is an estimated expense to be recorded over the building's estimated life. Well, that's true because depreciation is just based on a calculation that we're estimating. Like example for straight line, let's say your straight line depreciation is 10,000 every year. It's not like that's not entirely true. It's just approximately 10,000. So that's right. So that wouldn't be the answer. And C, as depreciation is recorded, shareholders' equity is reduced. Well, that's correct because depreciation is an expense. So in your income statement, it would decrease your net income, and therefore it would decrease your shareholders' equity in the return of retained earnings. And then D says, as depreciation is recorded, assets are reduced. And we know this is true because when you debit depreciation expense, you're crediting accumulated depreciation, which is a contra asset account, and that's actually subtracting from your long-term assets. So that is right as well. So the answer is A, and the reason why it's A is because depreciation represents the decline in the book value, but this is talking about the fair value or the value of the building. But you're only looking at the book value because that's value could go up or down, and that's why when you disregard an asset, you always have a gain or a loss on it. So the answer is A. Number 6. Which of the following statement best describes the matching principle? Well, before we answer this question, I'm just going to explain what the matching principle is. The matching principle states that whether revenue you have in the year, you should also record the expenses that incurred for that revenue. So for an example, let's say if your business is selling chairs and you're making money selling chairs, you also have to record how much that chair costs, because it's not a good representation if you're just showing all your investors how much money you made, but not exactly how much it cost to make. So let's look through the answers and see if we could find that definition. So A states total assets should equal total liabilities and shareholders' equity. That's wrong because, as in the first question, that's the general accounting equation. B says revenues should be recognized when they are earned and realized. Well, this is the revenue recognition policy, so that's incorrect too. C says revenue expenses that were incurred to earn that revenue should be reported in the same accounting period. Well, that is exactly what I explained, so that C would be correct. And let's just see what D says. So D says debits should always be equal to credits, and that's actually the dual effect. So that's not correct either, and it's still C. So number 7. Which of the following statement is true? Only permanent accounts are closed at the accounting period. That's not true because we know that all accounts that are closed are from the income statement, and those are temporary accounts. You'll never see an account like cash or a long-term asset being closed at the end of the year, so that's not true. Only temporary accounts are closed at the end of the accounting period. That's true because that explains why A is wrong. C, all accounts are closed at the end of the accounting period. That's wrong because in A we said permanent accounts are never closed. So that's wrong. And only the retained earnings account is closed at the end of the accounting period. And we know that's incorrect too, because all the expenses are closed and it's transferred to retained earnings, and retained earnings isn't closed. So the only possible answer for this is B, and B is correct. So let's slide over to question 8. A good system of internal control for cash should include a number of procedures that would facilitate the discovery of mishandling of cash by employees. Which of the following statements reflect a weak internal control procedure? So a weak one. And before I answer this question, let me just explain what internal control is. Internal control is just a basic procedure that a company can use to make sure the company is being efficient and effective. This could be just writing down all your revenues on a piece of paper, even using a cash register instead of going off by memory. It's just small procedures that companies could use. So let's go look through the answers. So A says all cash receipts should be deposited in a bank on a daily basis. So this is actually good because if you wait till the end of the month, cash receipts could be lost. So to do it on a daily basis is just very efficient. So that's not a weak internal control, and it's actually a very strong one. B says all major disbursements should be made by issuing serial number checks. That's also a good internal control because you're relating a number to the check, so you'll be able to find it easier and it won't get lost as easy as well. C states only one person should handle cash receipts and cash disbursements so as to reduce labor costs and limit access to cash. Well, this is questionable because usually for internal control, a person should only take on one task. And the fact that the person is handling cash receipts, so cash being received, and handling cash disbursements, cash being spent, it's not really a good idea because this person could feel pressured to not disperse as much cash because they know how much cash they're receiving. So this could cause a lot of manipulation and not as many cash being dispersed. So C is the correct answer for a weak internal control, but let's look at D just to see. So D says the function of receiving cash should be separated from the function of dispersing cash. So that's just the opposite of C, and D would be a good internal control. So number 9. The cash records and the bank statement of Mesa Company showed the following at the end of September 2011. So you have outstanding checks as of August 31st, 2011, which is also at the beginning of September of 8,000. You have checks written by Mesa Company during September 11, which is 50,000. So in total, you have 50,000 checks outstanding. But from the bank, only 54,000 checks were cleared. So this could be because of maybe they had written checks at the end of September that didn't clear yet, so they brought it over to August, and that's why there's another 4,000 in there. So the question asks the amount of outstanding checks at the end of September 2011. So all you do is you take the amount of outstanding checks the company has, and you take the difference of how much the bank cleared, and you get 4,000 as your answer. And the answer is B. Number 10. The primary reason for establishing an allowance account rather than writing off uncollectible accounts to bad debt expense is that the allowance method A conforms to the matching process. Well, this is right because the allowance account reduces your account receivable, and your account receivable is the one that helps a company gain revenue. So when the accounts receivable is gaining revenue, you also have to match the expense could be incurred, and which is the amount of money that you might not even be received. So this helps have a good representation of the amount of money you'll be actually earning. So it does conform to the matching process. Let's look at the other answers though. So B states that insurance that overdue trade receivables are not overlooked. Well, this is not true because your general trades receivable account actually just shows you all the dates of every account receivable. So that's not true. It just the allowance account actually just states the bad debt expense. So B is incorrect. C results in more accurate reporting of revenue. So they're saying revenue, and the account only handles expenses because you're debiting bad debt expense, and it only accounts for the true value of the accounts receivable. So it has nothing to do with revenue. So that's incorrect as well. And D says it simplifies the bookkeeping effort. Well, as you can know, when you were practicing your allowance method, it's actually a very tedious process with a lot of percentages and sums. So it's definitely does not simplify the bookkeeping effort. So the answer is A. 11. In 2011, Cyrus Corp reported net sales of $18,800 and cost of goods sold of $5,600, while King Limited reported net sales revenue of $22,300 and cost of goods sold of $9,300. Which of the following statement is correct? Well, if you keep reading, it always asks you about the percentage of sales and the gross profit. So what the question wants you to realize is that they're talking about the gross profit margin, which is your gross profit over your net sales. And they're giving your cost of goods sold, so you have to find your gross profit. So Cyrus has $18,800 in sales. Let's see what the cost of goods sold is. So $5,600. And then King Limited reported net sales of $22,300 and goods of $9,300. And $22,300 minus $9,300. So this is King. Let me just make sure I get that right. So 56, 9393. So your gross profit for each is 18,800 minus your 5,600. So you get a gross profit of 13,200. And for King, you get 13,000. So now let's see what they're asking. So King did a better job of controlling product cost as a percentage of sales than Cyrus did, as evidenced by its gross profit. So let's see. So for your gross profit equation, you'll take the gross profit with the sales. And let's see what we get. So we get 70% here, or 0.7. Here, let me just redo that so you can see clear. And then for King, you get 13,000 over 22,300, which is only 0.58. So King did a better job of controlling product costs as a percentage of sales than did Cyrus Corp, as evidenced by its gross profit of. Well, this is not true, because if you do the equation, we saw that Cyrus has a 0.7 gross profit margin ratio, and King only has a 0.58. So A would be incorrect. B says Cyrus Corp generated a lower gross profit percentage than King Limited because its sales revenue was lower than King's. Well, that is not correct either because, like our equation, Cyrus had a bigger one. So C says King Limited generated more revenue than Cyrus Corp, but it has a lower gross profit percentage. Well, this is true because in the question it says that King Limited had revenue of $22,300, while Cyrus Corp only has $18,800. But inevitably, Cyrus Corp had a bigger gross profit ratio. So the answer is C, and D is just none of these statements is correct. So that's not right. For 12, which of the following statement is true about earnings per share? So A, it is the only ratio required to be disclosed on the income statement. That's true because in your textbook and all the income statements, the only equation at the bottom is your earnings per share. B, it assesses the ability of the firm to pay its bills as they come due. Well, that's not true because you have no idea what your accounts payables are. You're just knowing how much shares increased by. So B is not true either because you don't even know what your accounts payables are. C, it evaluates the efficiency with which the company uses uses its assets to generate sales revenue. That's not true either because that should be your asset turnover ratio, and you're not even receiving any information about your assets, so you can't really draw any conclusions from that either. So that is incorrect as well, and D is just none of the statements is true. But that's incorrect because we said that A is true. And question 13 is not appearing, so I'll just explain to you verbally. So 13 says, which of the following statements are true regarding the statement of financial position? So question 1 of it says, one cannot determine the true fair market value of a company by reviewing its statements of financial position. This is true because in your financial position, you only record its historical cost. Number 2 states that certain internally generating assets, such as a trademark, are not reported on a company's statement of financial position. This is also true because a trademark is very hard to assess its actual value, so accountants don't report it on its statement of financial position. But when you rebuy a company, that it goes into the goodwill of it. So 2 is correct. 3, a statement of financial position shows only the ending balances in a summarized format of all statements of a financial position accounts in the accounting system as of a particular date. So this is also true because if you look at a balance sheet, you only see the sum of each account. They won't show you every single trades receivable, for example. So the particular options are A, none of these statements are true, which is incorrect. B, statements 1 and 2 are only true, which is incorrect because we said all 3 of them is correct. So the only possible answer is D, which is all the statements are true. And for question 14, the question states, upon review of the most recent bank statement, you discover that you recently received a not sufficient funds check from a customer. Which of the following describes the action to be taken when preparing your bank reconciliation? So non-sufficient funds, for example, is let's say you receive a $100 check and you're the company, so you record the check, debit cash, you credit revenue, and then you go to the bank, you give in the check, and it bounces. So this is the situation. So in the bank, with a non-sufficient funds check, there's no change because at the right away it says it's not working and they don't record anything. But on your books, you've already recorded debit cash, credit revenue, which is not correct because the check bounced, so you actually don't have that money right away. So as you see for the options, the answer should be decrease your books because you haven't received the cash yet. And then for the bank statement is that there shouldn't be change because they didn't record anything. They knew right away that the check bounced, so they didn't do anything. So if you look at your options, you see that the balance per bank statement is no change, and that for C is that it's a decrease. So the actual answer is C. So that is all of the questions for the multiple choice section. Thank you for listening, and if you have any questions, don't hesitate to see your TA or professor. Thank you.